John Kvale, and this is take two, complete take two, of our June 2025 capital market and financial planning review. I'm a little under the weather and fading a little bit, which you wouldn't know from the first video, but anyway, it is Sunday before the last day of the month, and I'm recording this right before noon. And the other video I did completely and realized that there was no video. It was only a screenshot. So lucky you guys, we get to redo this again. For those of you that are new, we do this in audio video podcast format, shortened podcast format. And so if you're driving down the road, keep your hands on the wheel. I will more than likely go a little faster with the second complete time, just because I know the high points to hit. So here we go. Let's get going. Those of you that are driving down the road, I am going to the first major event. And I say I'm posting this, I said it in the prior video that will hit the cutting room floor, that I do have a little bit of peril, and that is because this is fast moving. The tax law, and actually in this I say we use the prior month's video as our template, and when I pulled up the template from last month, this one was almost the exact same thing, except instead of 1,000 pages, the tax laws that I'm talking about, it's 940 pages. All right, quick purview into what's going on. The House finally passed a bill. It went to the Senate. It was over 1,000 pages. The Senate chopped it down to 940 pages. Now there have been leaks of what the tax bill looks like. There's all along been some leaks, but they've been taken more seriously now because we're so close to it. By the way, there's a self-imposed July 4th goal to get this across the finish line, which I'd give it about 50-50 at best. So anyway, here's where I say on Sunday AM, the 29th. Here is a couple of key things that are going on. Medicaid, SALT, and the reconciliation of the budget is the biggie. They're not going to reconcile the budget, and that feeds into, here's the most important part about this is, number one, that it's been delayed, and we look forward to bringing you this in a newsletter format that we'll send you a newsletter video and lots of updates on all of the tax laws. There's probably going to be a lot of them. Some of them are just extensions. It's going to be a lot of things, and I know we're holding a lot of people hostage on what's going on. I'm digressing. The important part, reading the Wall Street Journal this morning, they're expecting another $2 trillion, or the Congressional Budget Office is expecting another $2 trillion of debt. Okay, we can talk about the balance sheet. I know that increases the balance sheet over the next so many years. Capital markets don't care. Capital markets want economic growth no matter how they get it, at the peril of everything else. That feeds into something I'm going to talk about here in a few minutes, or in less than a few minutes. And anyway, bad, as I mentioned here, the tax cuts are bad for the balance sheet, but good for the economy. Good for the economy is going to be good for our portfolios and the economic growth. So again, they're agnostic. Now, I speak out of the other side of my mouth. Bad habits reinforce. I'm talking specifically to us as individual investors, and we've had these multiple sharp drawdowns and then complete recoveries. That is not the way it usually works. Certainly, as I mentioned, we're very awesome, and we're happy that they occur. That's not what usually happens. What we are concerned about is that people, especially newer investors, younger investors, even institutional investors that have not been through a true cycle, it doesn't always happen this way. You keep walking across that tightrope faster and faster, and then one time what really happens is there could be an extended period. And so I'm just warning ourselves to remind that it's not different this time. And I even mention it, what would worry us is if we start hearing it's different this time. But what we're doing is we're reinforcing bad habits for very reckless behavior. Just a thought worth interjecting. I don't know if that audio is gonna come up, but that is one of the dogs snoring. So, all right, I'm gonna go deep real quick on this, and it does look like this one's gonna be quite a bit shorter. We mentioned, went out on a little bit of a limb with our main research partner and mentioned last month or late last month that we're expecting an economic hiccup. Right after that, here's kind of where it gets deep. This is as fast as markets move. So those of you that are very interested in the details, this will be great. Those of you that are not, maybe not so much interesting. But here's what happened. So right after I did the post, everything's going status quo. We did have a lot of geopolitical things which have amazingly looked to have simmered down, and capital markets are looking past those. That's great. That could flare up at any moment. But on comes the talk with more seriousness of a new FOMC president. That would be replacing Jerome Powell, whose tenure runs out mid-2026. He will not be reelected. Couple of vocal, I do take this, I'll take this. It came out and said, hey, we'll lower interest rates as soon as we would take office. Well, that's all great. Lower interest rates would, all other things being equal, be a little bit of a tailwind to the economy. But again, one of our main research providers, if correct, they've got an increase in consumer price index, the major inflation gauge, coming out next, actually going through the end of probably late into the year. What does that mean? Well, that means that any kind of, if a Fed president got in and said they were going to lower rates on the heels of a higher inflation, they're going to be booed, number one. More than likely, Powell will stay in there. These bonds, the markets have kind of gotten ahead of themselves in front of what we expect to be a hiccup on the thought that that might occur. So you've got kind of a little bit of a trifecta, now even more of a trifecta. We were expecting a short-term kind of hiccup, but we wanted to bring this up to you because this is kind of all lining up. You got the geopolitical, you've got tariff, which turn around, the 90-day tariffs are due to expire on July 9th, probably no announcement before July 4th, and it wouldn't surprise us if there was another 90-day extension, but that weighs on the markets. And you got this other event, by the way, that's also pulled down the US dollar as well. That all other things is a little bit stimulus as well. So there you have it. Deep dive. I'm doing those. I've gotten good feedback on the deep dives. A lot of you really like the educational part of it, and I fear that we get lost in that. But I've also got an ETF series that's coming up. Next week is a holiday shortened week, and followed by the family getting ready for our annual extended remote remote location, which is a family favorite. I'll be in touch here not seamlessly. Everything just won't be in the office. But thank you for your time, and hopefully this video came this time because I don't have another one of these in me. All right, take care. We'll talk to you at the end of July. Bye-bye.